Ito,
Yes.
mas bilang.
Okay, everyone. Good morning. Right. There's several things I want to review before we begin the activities today. Now, the first thing is replacements. I guess next week from 22nd until 24th, there are holidays, right? So we need to find replacements on Tuesday. Tuesday is still a public holiday. Is it okay if we have class on the next day, Wednesday, which is our last class? And usually we have this midterm and also presentations on Wednesday afternoon. Maybe from 2 to 4 or 2 to 5. Is everyone okay on this date?
We have class in the morning and evening we go to gaming to make our prepare decision.
I see. Okay. Can we make a decision which day you are available for replacement?
Wednesday next week or this week?
Next week.
Next
Because
week, yeah. Next week. No. Next week we are available.
okay. Because
Right.
next Tuesday is still a holiday, so we can't have class. We got to find a replacement afterward. That means according to Peru, that means Wednesday is available, right?
But we are not sure whether they already come here or not. Not sure whether someone that go to holiday come back already or not.
That doesn't matter because Wednesday is no longer a public holiday. Anyone is still away because of your request for extra holiday. That is some things I can't help. Right? Okay. And therefore, can we make a decision next Wednesday afternoon from 2 to 4 or 5?
Okay.
Right? Okay. I will try to reserve this classroom. Otherwise, we will go to PK4. Here's for PK4. I'll try to complete again the wagon. Right? Okay, it's one song. Next Wednesday, 25. January. Okay. Right. And today's agendas. Today I'm gonna cover two topics, which is topic 13 and 14. Right? But I'm confident that I can cover these two topics because for topic 13, I'm gonna skip some slides because I think I don't have to explain one of those slides and focus on only those important slides. And therefore, I can speed up the explanations to cover two topics, right? And today we will have quiz, no? As I announced on Smart 3, we will have quiz. For this quiz, don't worry so much, just a multiple choice, right? I will distribute these papers after the two topics here. So I will let you do the quiz. How much time do you need? How much time do you need for this quiz? Just not many questions. 5 minutes.
Kailangan ko, coba begitu yang link.
15.
1 hour.
Multiple choice.
1 hour.
30 seconds, one question.
30 minutes.
I will give you 30 minutes. right? Okay.
How many questions?
You can discuss among yourself, but the requirement is you should refer to lecture notes. You can discuss, but should refer to lecture notes. That is called quiz, right?
Boleh ke tanya?
Your cumulative score, number 3. Now this one, I believe that last week you guys had this oral presentation and mini project submitted. I have marked your mini project, I have marked your oral presentation, but I'm not ready to upload the information on Smart3. Maybe I think I will upload all together with the quiz result. Okay, within this week, you receive your overall result, your cumulative score from midterm assignments, mini project, oral presentations, quiz. Okay. And this week, what are we gonna do next week? Should we have class? Should we have class next week? No. No? Who say no?
So 25 January?
This week, yeah, 23. We still have class for this one because I want to do some revision for your final exam. Hopefully, that revisions will help your final exam. Okay. I'm sorry for those who still holiday. Okay, but hopefully we can get the information about the final exam next week. Attendance. Okay, about your attendance. Now, if you notice, I remind you one more time, if you notice that your attendance are not complete with some crosses, I hope you can provide letters. Okay, I still hope you can provide letters, although it just absence maybe one or two classes. Okay? And last but not least, number 6, cost evaluations. I think 2 days ago I checked SNP. I have only about 15 classmates have completed this one. You know that it is compulsory to complete this one because you need to complete this one in order to get your exam slate. Otherwise, you can't get an exam. That's my understanding, right? Okay. Just complete this one as soon as possible. Okay, we continue our tutorial discussions. I guess last week we had tutorial 12. Okay, let's discuss this problem, which is quite interesting problem if you look into the statement and the question. Okay. Right. Now, first of all, let me read the statement to you. Norway taxed to the euro, but soon after EMU benefits from a Again, Norway passed to the euros, but soon after EMU benefits from a favorable shift in the world's demand for non-Norwegian EMU exports. What happens to the exchange rate after Norwegian crown against the non-Euros currencies? how is Norway affected? How does the size of this effect depend on the volumes of trade between Norway and the Eurozone and economies? Right. Now, first of all, we understand that Norway is one of the EU countries, correct? Is it part of EMU? How many countries are there in EMU? EU, European Union, we have 27. Used to be 28. After UK left EU, now they have 27. And EMU, how many countries in EMU? 20, right? 20 countries. Norway is one of the EMU countries. What is the full name for EMU? Economic and Monetary Union. Okay. Now, please look at this carefully. There are 3 questions here. The first question asks, what happens to the exchange rate of the Norwegian krone, right here, this is KR, right, against the non-euro currencies. Non-euro currencies can be any currency outside Euro, outside European Union. For example, we can consider this one as US dollars, this one as Malaysian ringgit, something like that, okay? This is the first question. The first question here, I label 1. How is Norway affected? Second question. How does the size of this effect depends on the volume of trade between Norway and the Eurozone economies? This is question number 3. Do you remember Eurozone? Eurozone or Euro area is where Euro is used. Okay? Okay, let's answer this question. I'm not going to write an essay to explain to you this one. I prefer to use a diagram to explain this one so that you can see clearly what happens when there is a favorable shift in the world demand for non-Norwegian EMU export. Okay? Right, maybe I should put here. This word. Right. Okay. And then I will put here's demand, maybe. Okay. And then I will need the 2 area here. One is Norway, and the other one is EMU. Okay. And here, I put an arrows pointing to the 2 area. And what I'm gonna write here is integration. Integration. And we understand that the currency in Norway is the Norwegian krone. Norwegian krone is KR. And what is the currency in EMU? Euro. Okay. Euro. Now let's answer the first questions now. What happens to the exchange rate of the Norwegian krone against the non-Euro currencies? Here's, I'm gonna write the exchange rate like this. This is number 1, okay? The exchange rate is supposed to be the krone, Norwegian krone, KR, over. There are too many currencies I want to write here, okay? Because there are too many countries in the world. So maybe I just write others, right? Others. And here, we actually need the real exchange rate between the Norwegian krone and other currency. That is equals Can anyone tell me what is the formula for real exchange rate? The nominal exchange rate times P. This is the local price for foreign price. Foreign price, right? Okay. Others. And below here we have local price. You know, right here the price in Norwegian krone. Okay, now, according to the statement, a favorable shift in the world demand for non-Norwegian EMU export. So what will happen here is that the price will increase. Okay, the price will increase. Let's consider this one. When this one increases, what happens to the real exchange rate?
Decrease.
The real exchange rate will increase or decrease?
Decrease.
Decrease, right? Okay. The decrease here implies real exchange rate appreciation or depreciation. Appreciation. This is real exchange rate appreciation. Okay, now this is real exchange rate. What happens to the exchange rate, the nominal one? We understand that the formula for nominal exchange rate is written like this. Okay, this is krone, this is others. This is equals to price over price. The above one is the price of local price or international price, foreign price. This one is local, okay, and this is others. Right, if I show you both the real exchange rate and the nominal exchange rate, I feel that some of you might be confused. Okay, what's going on? Since the question requests just this one, exchange rate, not real exchange rate, I think we don't have to consider the real exchange rate, but just consider the nominal exchange rate. Okay, because this is what the question is written here. It's not real, but nominal, just a nominal exchange rate. In this case, don't worry about the real exchange rate. I don't want to confuse you here. Just focus on the nominal one. Okay. Now, this is price, and this is product output, and this is EMU. You know, EMU. Demand and supply in 4 EMU countries. This is supply curve. This is demand curve. According to the statement, the demand for non-Norwegian output increases. That means the demand for goods produced in Norway decreases. The demand for goods produced in other EMU countries increases. You understand this? Okay. Then, how will that affect the demand and supply curve for EMUs here? The demand curve will shift to the right side. Okay. Let's shift the demand curve to the right side and see what will happen. Can you see what happens to the price?
Increase.
The price increases. When people from other countries begin to favor products from EMU, demand increases. And this usually accompanied by an increase in the price. Okay? The price in other EMU countries, not in Norway. So go back to this equation here, equations number 1. The price of others increases. Is it correct? No, this is not correct. This is the price of others than EMU, not EMU itself. So from here, we can't say this increases, and we can't say Norwegian's price increases either. Right? And what happens is, we can say that the price here increases. But when the price here increases, the exchange rate here becomes higher. Right? This is currency appreciation or depreciation.
Depreciation.
Depreciation. Let me see if there are other ways to explain these situations. Okay? Because I want to link it with EMU's exchange rate, but here we just can't see EMU here. Okay, what happens to the exchange of Norwegians against non-euro currency? Let me delete this one. We try to use the real exchange rate. Okay. And others. Times the price of others. And this is the price of EMU, euro. Okay? Now, do you understand why do I write euro right here? Why do I write euro here and I write kron right here? The reason is because kron is packed with euro. Okay? Kron is packed with euro, and what happens to euro will affect the currency in Norway. Get this idea? Right? Now, just now I throw you the graph, and the demand curve shifts to the right side, the price increases. That means the products in EU, in EMU, increases. The price increases. So we can write here, the price here increases. Okay? Now what happens from here when the price in euro increases, EMU increases, the real exchange rate here decreases. Now overall, what is the conclusion here? The real exchange rate incur appreciation or depreciation? Appreciation. Right. Now this is the ultimate explanation. This is the ultimate explanations that we want. Okay, so we answer the first question. What happens to the exchange rate of Norwegian krone against non-euro currency? The answer is the real exchange rate of Norwegian krone against non-euro currency decreases or appreciates. The reason is the price level in EMU increases when the demand increases. Right? And number two, how is Norway affected? This is very straightforward. This question is very straightforward because when the world shift the demand toward EMU rather than Norway, that means Norway's export decreases. Okay? And for EMU, export increases. When export decreases, what happens to Norway's GDP? GDP decreases. Okay? But other EMU countries, GDP decreases. Okay? Now we have the second explanation here. This is number two. Okay? This is number two. And lastly, how does the size of this effect depends on the volume of trade between Norway and the Eurozone economies? If you still remember last week, we talked about the degree of integration. Do you remember economic stability loss and monetary efficiency gain? The two concepts. Some things that look like this. Do you remember the GG schedule and the double L, the LL schedule? It is. And here's what we measure here. The gain and losses for integration. Now from this graph, it says that the countries must be able to reach integration up until this point. Otherwise, loss will be higher than gains. Or if the integration is more than this level, gains will be higher than loss. That is the degree of integration until here, right? Now in this explanation, I write here integration. The explanation here is the effect depends on the extent to which Norway is integrated with EMU. The stronger the integration, the less impact from the shift of the worst away from Norway to EMU. Because if the worst demand shifted away from Norway to EMU, that means export from Norway decreases, correct? But if Norway has a very strong integration with EMU, that means Norway's trade with other EMU countries is strong. Meaning, Norway's, if the integration is strong, the shift of the worst demand away from Norway will not generate a huge impact on Norway, because Norway can trade with other EMU countries. There are 20 countries in EMU, meaning what is lost from other countries can be compensated by trading with other EMU countries. Right? Not difficult to understand this. However, if the integration is weak, if the integration between Norway and EMU is weak, that means international trade between Norway and other EMU countries are weak. That means if the worst demand shifted away from Norway to other EMU countries, and at the same time, Norway's trade with EMU is also weak, that's gonna be a problem. That will generate a huge impact on Norway, because Norway cannot find substitute from other EMU countries. Okay? In contrast, if the integration is strong, Norway does not have to worry anything, because Norway can find trading partners from EMU for trade, for export and import. Okay? So the explanation here depends on whether the integration here is strong or weak. Okay, strong or weak. If the integration is strong, then low effect. If the integration is weak, then high effect. If it is strong, the effect is low. If it is weak, the effect is high. Well, I don't know whether you feel anything about these problems, but I feel quite interesting about this problem. But anyways, I hope you can understand the explanation here. Okay, we'll take a break for 5 minutes. let's continue. As I said, today we're going to cover the last two topics, 13 and 14. Let's begin with the next topic, which is global capital market, in other words, international capital market. Do you still remember 7 themes in international economics? The last theme, can anyone mention what is the last theme? There could be the quiz questions, I'm sure. Gains from trades, pattern of trade, protectionism, determinations of exchange rate balance and payment, coordinations of international policies, and international capital market. All right. In fact, in the past few lectures, we have somehow discussed capital market. For example, lending and borrowing. That is also a concept under the international capital market. But we do have the specific topics that focus on the international capital market, like this topic here, right? Now this building, very beautiful. I understand that you recognize this is a building from in the United States. And if you look at the name carefully, what's being written right here?
New York Stock Exchange.
The New York Stock Exchange, right? New York Stock Exchange. If you have a chance to travel to this country and you stand here, you feel like, wow, it's so impressive, the buildings, especially the pillows, Okay. Now the reason I show you this building is because New York Stock Exchange is also the largest stock exchange in the world. Okay, largest here, it doesn't mean the size of the building itself. It means more about the volume of trade that will determine whether the stock exchange is small or big. Okay. Just like countries, okay? During your presentation, I asked questions to, I think it's Yao, mentioning about the size of Australia, whether it's a big country or small country, okay? When we consider countries, yes, land size is one definition of country size. But in economics, we talk more about the population and GDP in the countries. That will define whether that country is big or small, right? Let me also give you an example of maybe university. Is a university big university or small university? Do you consider UMS is a big university or small university? What do you compare it? If you consider seeing Malaysia maybe it's big, I don't know. How do I compare this one? The size. Because last time we talked about land size, right? Australia is a big land, so you consider it as a big country. But compared to the United Kingdom, population is bigger, GDP is bigger. It seems to me that UK is a bigger country in economic sense. But at university, now we're comparing university. UMS, how many students in UMS? Approximately, what I remember is 2020, it's about 14,000 students, undergraduate. And what about academic staff in UMS? About 1,000. About 1,000 academic staff in UMS, and about 15,000 undergraduate students in UMS, right? Now we compare to another university. Maybe, I don't want to compare with another university in Malaysia, maybe foreign university. University of Cambridge. University of Cambridge, how many academic staff? Based on what I understand, what I remember, is a couple of universities out there. University of Cambridge has around 6,000 academic staff. 6,000 academic staff, and undergraduate students is twice more than UMS. And now we talk about the land size. UMS, what is the land size of this university? Very populous numbers. And when people ask us about UMS, we always like to mention these numbers. It's 999 acres.
hectares.
999 acre, 39 acres. That is the size of campus in University Malaysia Sabah here. And what is the size of Cambridge? The Cambridge size of, is about 700. That is the size at the University of Cambridge. Now, which one is bigger? If you consider land size plus University in Malaysia, Sabah is bigger. Very beautiful landscape. Okay, bigger one. But if you consider university as the size of staff and student, and certainly University in Malaysia Sabah is much smaller compared to Cambridge, right? Now this is the comparison, just like stock exchange. We don't look at the size of the buildings to justify that this is a big stock exchange. We have to look at the trading value of this institution to say whether it is big or large, or big or small. Okay? And we also have other examples here. For example, Nasdaq and also Japan's exchange group here, also quite big stock exchange in the world. Right. International or global capital market is an arrangement where traders from different countries buy or sell tradable financial assets. Okay? You can also consider this as a platform where traders like you and me, or investors, or government agencies or firms want to trade financial assets. Okay? Trade here can involve sell or buy financial assets. Example of financial asset here: securities, derivatives. I believe this is some things you have learned before in your financial management courses, maybe. Yeah. Now, international capital market usually consists of a group of interconnected markets with close network and high-tech communication system. You don't assume that New York Stock Exchange works alone. No, it doesn't work alone. New York Stock Exchange has to be connected with other stock exchanges in Japan, in China, in Malaysia, for example. Okay, do we have a stock exchange in Malaysia? Do we have? Not. What is the name? Yeah, Kuala Lumpur Stock Exchange. What is the name? I think it's Bursa something. What is the full name? I guess you know, but just don't remember the full name, please. Okay. Right, let's move on. Second point, foreign exchange market is part of international capital market. Foreign exchange market. What is the short name for this one? Forex. Okay. Forex is also part of international capital market. Institutions engaged in international capital market include central bank, or national bank, or federal reserve. It depends on which countries you are in. Some countries call it central bank, some countries call it national bank, and in the United States, people call it federal reserve. Right? Commercial banks. Anyone can give an example? Commercial banks. Any bank in Malaysia can be considered as commercial banks. Maybank. CIMB, and what else? RHB, RHB Bank, yeah, all those are commercial banks, right? Large corporations, I don't need to give an example, you already recognize. Non-bank financial institution, for example, insurance, okay, non-bank insurance. Other government agency, example, what government agency will deal with international capital market? The Ministry of Finance, the Ministry of Trade are examples of government agency that will deal with international capital market. Gains from trade are not limited by free trading of goods and services globally. Banks engaged in the international capital market provide worldwide payment system to lower transaction costs. And this is also a reason that a bank is being called intermediaries. Banks is called intermediary because it serves as the middle institution, a middleman that will facilitate your transaction with other parties. Okay? For example, what example can we give here? Credit cards. Credit cards. With credit cards, you go and buy something from Shopee, for example. Although when I mention the word Shopee, I feel a bit frustrated listening because I ordered something. It's been out for delivery since last week, and until today I haven't seen my goods. You know? And last night I tried to call to that headquarters. The lady picked up my phone and she hung up. That is a double frustration. Anyway, I'm still waiting for my parcels to be delivered. Okay, stop talking about credit card. Don't want to talk about that anymore. There are generally 3 types of gains from trade. You understand already goods and services. Have you learned this one? Gains from trade. Who specializes in good A, who specializes in good B, and who will export good A, who will export good B. Some things that we have learned early, very early in the course, right? Okay. Intertable. Intertable. This one involves period, time period, current period, and future period, right? For example, we learned about a country that is biased towards current consumption. A country that is biased toward current consumption will usually allocate resources to produce goods and services now, and then export the goods and services to other countries, right? That is the countries that bias toward current consumption. Now this country, because they produce a lot of goods and services now, they export a lot now, they also receive a lot of money now. And this money can be used as lend to other countries, and they serve as the lenders, right? In contrast, a country that buys toward future consumption, this country usually has a good investment prospect, good investment opportunity. So what this country do is, they need to borrow money now in order to fund investment projects, a variety of investment projects. Hopefully this project will be accomplished in the future. So in the future, the country can produce a lot of goods and services to be exported, right? Now this is in the table. We have done something about this before, right? Asset compares to liability. Asset is something you own, it's your asset. Liability means something you owe. You need to pay back, right? Asset here, I mean, we can also have gains from trade by trading financial asset here. Borrowing and lending is one example. Okay, and you can also think about asset like stock, shares, something like this, or government bond. Those are assets. Now this diagram, it looks very simple, but it carries important information. First of all, usually we have our home country, and then we consider foreign countries like this one. And based on differences in the resources endowment between these two countries, like maybe home is labor abundant, and foreign is capital abundant. And good egg is labor intensive, good wine is capital intensive. That will determine the pattern of trade between home and foreign. Something we have done before, I just generally remind you, right? With these identifications of pattern of trade, these two countries can trade with each other as shown by the red line, okay? The red line connecting the two countries. They can trade. Trade what? They can trade goods and services. This is trading goods and services is the first type of trade, correct? Okay, as I mentioned here, the first type, what? The most general trade between countries. Now, other than goods and trade, goods and services, I also mentioned intertemporal. Remember, intertemporal. I said bias toward current consumption, so maybe bias toward future consumption. Now, home country and foreign country, certainly these countries have the characteristic whether this country bias toward current consumption or future consumption. If this country is a country that bias toward current consumption, that means home can lend monies to foreigners, right? And foreigners will be the borrower, and home is the lenders. Now, this borrowing money, home lend, foreign borrow. This involves exchange rate, correct? Because they use different currencies. This involves exchange rate and also interest rate. Now, this happens in which market? Borrowing and lending. It happens in which market? International capital market. Right? International capital market. And that becomes asset. That becomes asset because it involves borrowing and lending. This is asset, right? So this diagram basically summarizes the gains from trade by trading the three types of activities here: goods and services, intertemporal, and also asset. Right? Okay. The trick of asset here, before someone makes up a decision to invest in asset, there are three things that you should consider here. The first one is risk. I believe this is also something we have discussed before. Do you remember the 6 scenarios, the 6 cases that we need to do some calculation? Okay. One of the things that we should consider is risk. Risk happens because we are uncertain. We are uncertain about what we want to invest. For example, if you want to invest in US currency, you are not sure whether the US currency will devalue or revalue. In other words, whether the US currency will appreciate or depreciate against Malaysian ringgit in the future or 1 year from now. That is something you are not sure. That involves risk if you buy a lot of US dollars. Okay? And another example is gold. Investment in gold. Very popular as well. Okay? You expect that the gold price will increase, okay, and you make a lot of profit, hopefully. But most of the time, our expectation is wrong because we don't have the essential information. We are lacking in experience. We don't have the essential knowledge, right? You expect gold price to go up, but gold price decreases. Then you get lost. You lost a lot of money, right? That is a risk. That's risk. Okay. Another one is portfolio. Portfolio is like, let me see what kind of example I can give here. Portfolios. Let's consider computer folders, you know. When you open your folder, you have a list of things, right? The portfolio consists of multiple types of assets that you want to invest. It can be shares. You in your portfolio, just like a file, just like a folder. You have stock, you have shares, you have bond, all different kind of investment assets in one portfolios, right? Some of the banks, commercial banks, also offers these kind of portfolios. For example, I don't know whether you have heard about unit trust. Unit trust is one example. If you have Maybank account, you can see this information also, which is one kind of investment, right? But how do you want to build your portfolio? That is something is your decision. Okay, you can ask your financial advisors to give you consultations what kind of asset that you want to invest. But yeah, it depends on how much you believe and how much you trust. For example, that person will give you advice. And first of all, you need to understand the menu. The menu. If you go to restaurants, for example, you pick the menu. You have a list of foods to choose, right? In order to build your portfolio, you need to refer to the menu. Sometimes, when we want to do an investment, we just based on what we prefer, what we like. We don't do research at all about the menu of things. For example, we heard a lot of people say, I make a lot of money from trading gold, trading silver, something like that, or buying shares from Apple, for example. That is what you heard. You didn't do any research. When you want to build your portfolio, you need to do some research about the list of assets available in this menu. There are a lot more investment opportunity or asset that you can consider. Not just gold, not just silver, not just share from Apples, no. Okay? Menu, I can generally tell you, for example, commodities. There can be a general category for commodity. Commodity here involving gold, silver, natural gas, oil, all those things belongs to commodity, right? You can also consider index. Index like can be cumulative of multiple assets to calculate one index. You can also consider currency, trading in currency. For example, US dollars and euro, right? You can also consider cryptocurrency. Nowadays, there are different types of the long list of varieties of cryptocurrency: Bitcoin, Litecoin, Ethereum, and what else? A lot of them I just can't remember this, right? So before you make a decision or advise someone to invest in asset, building a portfolio is important because there is one reason why building a portfolio is important rather than investing in just one asset. Okay? We need to do research on the list of items in the menu, which one is the most appropriate. Maybe I can just roughly tell you here. If you want to invest in portfolio, meaning you need to have a pool of different assets. But some of these assets can be highly correlated with each other. Meaning that if the price of one increases, the other one also increases, right? gold price and silver price, for example, are highly correlated. When gold price increases, you can also observe increase in the other price. Right? What I need to mention this one because there is one concept called diversification. Diversification is to reduce risk. Okay? And to perform diversification, you need to search from the menu. Search and research. You search the list of items and then you perform research for each item. That is search and research. Okay? Now, first thing first, we talk about risk. Just now I said risk is a situation when we are uncertain about a phenomenon and incurs the possibility to lose our asset or value, right? Risk aversion. I'm not sure if you still remember the three concepts we covered in microeconomic 2. There are generally three different types of risk behaviors. One is risk aversion. Risk aversion means an attitude that tries to avoid taking risks. That is risk aversion. Someone that does not like taking risks. Risk aversion. Another one is risk seeking. Risk seeking is someone who has the attitude to take risks, who love to take risks. That is risk seeking. Okay? Risk neutral. But this one is a gray area because risk neutral means someone who doesn't really mind to take risk or not take risk. If I get something, fine. If I want something, is fine. Okay? For example, a rich man. A rich man who want to invest in a stock market. This rich man, if he lost some investment money, that's fine because he's rich, right? And if he gains some money, it's fine. Not much gain, it's fine. Some things like that, just an example. Okay? Some people can be in one of these three characteristics. I don't know about you. And it says maybe risk seeking. I'm not sure. What about myself? Am I risk neutral, risk seeking, so risk averse? I think I am risk averse. I don't want to take risk. Okay, but it depends on what kind of things that you are taking. Okay, maybe for some activities you are risk seeking. But some other activities you try to be risk averse. Okay. Right. Let's complete this one. This is an expected value, also known as an average value. And in this statement, it says it means 1,000 in asset, and the price 1 ringgit increase in the price of stock is equals to 1,000 profit. That also means 1 ringgit per share, and this person wants to buy 1,000 shares. So the total cost is 1,000 ringgit. Chances are expectations of 50-50 chance of the 1 ringgit increase or decrease in the stock price. Okay? So 50-50 chance, that means 50% will lose the money. 50% will gain money. So on average, we just times the total possibility here, 1,000, with probability. This is probability. Okay. This is probability, which is 1/2, and altogether you get 0. And for a risk-averse behavior, These kind of persons will try to avoid taking this risk, even if the outcome is zero, it's not negative. Don't put all eggs in one basket. This is some things that we already discussed also in microeconomics too. So maybe here I just roughly, generally inform that this is a concept of diversification, a portfolio diversifications I mentioned before, meaning that rather than investing in just one particular asset, we can consider investing in different assets in one portfolio. The reason is we want to diversify the risk. What does it mean by diversifying the risk? We can look at this table here for an explanation how diversification can reduce risk. This essentially means that we're trying to avoid loss. We're trying to avoid loss by reducing the risk. Okay? And the approach here is diversification. It considers two assets, asset X and asset Y. Here's I consider the same assumption, one ringgit per share here, but we have two shares, X and Y, and there are 50-50 chance also to gains or loss, right? Now from here, since it say that allocate evenly the 1,000 between two assets, that means we allocate 500 for share X and 500 for share Y, right? If both of them increase in the price, Y increase 1 ringgit and X increase 1 ringgit, certainly you will get 1,000. It's 1,000. Both of them increase in the price. Now what we expect here is that we want the price to increase because the increase in the price is where we earn profit, right? Now if both of these assets show an increase in the price, okay, then we get 500 from Y and 500 from X, totally we get additional 1,000. But what if both of them decrease in the price? You lost 500 from X, you lost 500 from Y. Overall, you lost 1,000. And if one asset increases the price, the other one decreases the price, there seems to be offsetting. The one with the price increases will offset the one with the price decreases, right? You gain 500 from here, and you lost 500 from this side, overall you get 0. 0 is not loss, correct? This is loss. This is not loss. And this is loss not. This is not loss. And this is loss. Now we calculate the probability. The probabilities of loss if you just invest in one asset is that you have 1, 2, right? 1 over 2. 50-50 chance. Okay, if one asset, the probability is 1 over 2. If two assets, here, if you invest in two assets, what is the probability here? 1 over 4. Because you have only one possibility of loss here. And this one is gain. 0, as I said, is not loss. It's 0. Negative is loss. So your probability here is 1 over 4. 1 over 4 is equal to 0.05. Okay. 0.25, and this one is 0.5, right?
Yes.
Yeah. And this is to show you how diversification reduces risk. You reduce the probability to get loss. Okay? From 0.5 to 0.25. Right? Okay. Menus. This is the last thing in this diagram. Okay, number 3 is the menu. Menu here, there are 2 types. One is called equity, and the other one is called debt. Equity here, for example, if you want to buy share from Microsoft, from Facebook, for example, you get the share, and that is your equity. Okay, you are part of the player of Facebook, for example. But of course, you can't make decision for Facebook. If you want to make a decision for Facebook, I think you have to own the shares up to 70%. But there will be a lot of money, right? A grant to a firm's profit. Yes, when you own a share of Facebook, for example, then you have the chance to get profit, earnings by trading from the firm's profit. If Facebook makes a lot of profit, for example, and you own a share of Facebook, then you can get dividend payment from Facebook. Okay, the share. And you have to understand that this is not Facebook paying you, but you are involved in the capital market. Okay, the capital market will pay. Means you get paid through the international capital market, not directly from Facebook. And the other ones, that is like bond and bank deposit. Why do we call this as debt? Why do we call this as debt? Bank deposit. You put your money, you save your money into a bank account. What will the banks do with the money?
Yes.
The bank will just put your money into a share and lock it forever until you want to take it out.
No.
What will the bank do with your money in the bank's deposit?
Invest. They will
Investment. Okay? They will perform investment, or they will lend your money to other people. Loan. Okay? And your deposit is where the bank is able to lend money to other people. Otherwise, the bank has no money to lend, right? Okay? That's why your deposit to the bank is your assets. But your deposit to the bank is the liabilities to the bank. The bank owe you the money. Okay? If the bank uses the money for lending, for investment, then the bank owe your money. That is the liabilities to the bank, but that is your asset. Okay? Asset returns by principal plus interest gain is something we have discussed based on the 6 cases in the past, right? Right, now this one I'm going to skip, just now I explained to you already. I'm going to skip some slide here. This one is one of them, so I'm going to skip. You can read this one at home. This is just the structure. The structures constituting the international capital market, right? I'll go here. The growth of international capital market. There are 3 policies here. These are policies, okay? These are policies. We call this model as the Oxford-Taylor's Open Economy 3 levels. What does it mean by 3 levels? And maybe we can talk about dilemmas just for. What is dilemmas? Okay, for example, when you're waiting for your parcels to be delivered to you, you are thinking, you know that your parcel has arrived, that port, that company, that's whatever you want to call it, factory maybe, okay, or the warehouse. You are thinking whether you want to correct it by yourself going to the warehouse, or still want to wait at home waiting for that delivery to happen. That is dilemmas. Yeah, you can't make a decision between 2 stuff. To go there to correct your parcel or wait for it to be delivered. That is called dilemma because we are considering a decision between two activities. And here we have three. We have three aspects to be decided. Policy 1, policy 2, policy 3. There are three things to consider here, so we call it three lemmas, right? Three lemmas. Now, what happens here is that this is called the Oxford-Taylor's trilemma, because under this explanation, a government or a country cannot use all these three policies at the same time. No. Okay? They can't use all three policies at the same time. If the country can use all these three policies at the same time, there's no trilemma, there's no dilemmas. What happens is, the maximum policies that the country can use are two. Two combinations. It can be 1 and 2. It can be 2 and 3. It can be 1 and 3. If I label this one 1, 2, and 3, the combinations that a country can take is just like 1 and 2, 2 and 3, and 1 and 3. You can't use all these three together. The reason is, if a country uses three policies together, the policy will crash. Okay? And crashing among policy means the government will fail to achieve certain goals or targets. Let me use these two examples. Let's say 1 and 2. Let's say 1 and 2 is taken. That means the governments will pursue fixed exchange rate, will pursue monetary policy. You remember foreign exchange policy? To allow the exchange rates to go up or down, something like that. But when you fix the exchange rate, that means you are packing your currency with other currencies, like US dollars. It doesn't allow it to fluctuate. That is fixed exchange rate. Monetary policy, monetary expansion or contraction in macroeconomics. In macroeconomics, monetary expansion, what does it mean? The government increase money supply and reduce what? Increase money supply and reduce tax, right? Reduce tax. What about monetary contraction? Monetary contractions, the governments will increase tax and reduce money supply. Okay, that is monetary expansion and contraction. Now, why I say if the country use 1 and 2, the country cannot at the same time use number 3. When you pursue fixed exchange rate, that means you must use your monetary policy, expansion or contraction, to keep this fixed exchange rate. Okay, maintain this fixed exchange rate. But if the country also wants to pursue freedom of capital movement, this also involving money supply and demand, like borrowing and lending internationally. Okay, how does this one can happen if you already fix the exchange rate and you already use this one to control the exchange rate? Can't happen, because to use monetary policies to keep this exchange rate, you have to control the money supply and demand in the country. Okay? And if you allow freedom of capital movement, that means you cannot control money supply and demand using monetary policies. That will crash. This policy will crash with this one. Right? That's why this is called a trilemma. If I want to explain to you all these three cases, maybe until this 6 o'clock maybe, I can finish explaining them, because this is really a long story to explain one by one. Yeah. So I'm not gonna explain this one. But the basic things that you have to understand is the trilemma here, just that the maximum combination are 2 policy, not 3. Okay. Now, offshore banking, this is also something I'm gonna skip. there are several slides about offshore banking. The definition is banking businesses operate from outside the bank's home country. Which area in Malaysia that can be considered as an offshore financial center? Offshore financial center is usually characterized by a lot of foreign banks operate in that area. Which area in Malaysia is considered as offshore financial centers? It is very near to Sabah here. What is the name of this place? Have you been to Labuan? Have you been to Labuan? Labuan is offshore financial centers. You don't know that? Okay. Right. As I said, I'm gonna skip this one. You can read the point here by itself. Right. The one I want to jump to is banking value. The banking value here is very important because it can be the route towards a major economic crisis. Okay? If not financial crisis, banking failures here can lead to major economic crisis. Bank failure happens if the bank cannot meet obligations to the depositors. What does it mean by obligation? Obligation here is the bank's responsibility to serve the clients. For example, if you go to the main bank, okay, and you want to withdraw money, that is the responsibility of the bank to let you withdraw the money. Either you go to the counter or you withdraw the bank through ATM. As long as you can get the money, the bank has fulfilled its obligation, has fulfilled its responsibility. Now, what if you go to the bank, you go to the ATM, you withdraw money, and the machine tells you the machine is empty, it's empty of cash? Where do you go? The ATM, no more cash, you can't withdraw any money, then where do you go? Are you going to the police station? As a client, as someone who sends money, where do you go? You can't go home and tell your parents or families or brother, sister, I can't withdraw money now. How? No. You have to, I think it's the next place you're going to go is to the counters, right? Hopefully it's the counters, you fill out the form and you withdraw money through the counter, you can get the money, right? The machine, maybe it is empty temporarily, but the counter is not temporarily empty of cash. But what if you go to the counter and you withdraw money and the lady tell you, I'm sorry, we have no more cash. What do? You go to another bank branch, you try it again, you withdraw the money, and the same thing happens. You go to 10 banks branches, you can't withdraw 1 cent.
Use.
We call it that the bank cannot fulfill its obligation. That situation, right? And if this situation happens, what will likely happen next is that nowadays we have smartphone, right?
Cashless.
And usually when we go to 1 or 2 banks who can't withdraw money, we start to tax rule. Maybe Facebook or all our social media friends or something, and telling them the bank has no more cash. The bank has no more cash. The bank has no more cash. Or something like that. And in the end, a lot of people, we have the same perception. The bank has no more cash. What are we going to do? Where's my money now? Accept my money to the bank also. Now you're telling me no money? Where's my money? That will raise one thing, which is panic. That is called financial panic. Okay? Financial panic is usually happens to a lot of people. A lot of people in that area have the panics that the bank having problem. The bank are having problem. Okay, we'll talk more about this one. I'm diving towards the points of financial crisis and economic crisis now, but I'm trying to give you some more general idea before you get to go towards the understanding of the economic crisis. Now, banks use depositors' monies as fund for various forms of investment project. This is something you already understand. For example, if you want to buy a house, buy cars, to invest in businesses, you can loan from the bank, right? But these loans come from where? It's from people's deposit, right? From people's deposit. Values of the banks to repay depositors can cause the depositors to lose confidence. Just now I give you the example of financial panic. When people have this panic, that also means they loss of confidence towards the bank. I'm not confident with this bank anymore because you can't give me my money, right? Okay. Just use this example. Bank A. Bank A failures to meet obligation. Failures to meet obligations here can also mean the banks are not able to repay the lenders. Meaning, bank also borrow money from others' places in order to fund its operations. Okay? If Bank A fails to meet its obligation, the problem spills over to the lenders of the bank. Meaning that lenders, who can be the lenders to a bank? Who can be the lenders to a bank? Can you and I serve as the lenders to the bank? Yes. When we deposit money, we deposit to the bank account, the bank will use them for investment project, for example. For lending, for investment. Okay? We are lenders. The bank is borrowers, right? But if the bank cannot pay us our deposit, meaning when we want our money at one point in time, the bank cannot pay us our deposit, that will create a problem that the bank fails to meet its obligation. And when this happens to a larger scale to many people, that will create the situation for general loss of confidence in banks. Okay? People will start to have the perception that the failures to meet obligation happen not just to one bank, but multiple different banks will do the same. Okay? This is a general loss of confidence in bank by people. Number 4, banks fail to fund investment and consumers' durables expenditures. This is a consequence. When general loss of confidence happens, all those other banks working just fine, but because of this financial panic of people, other people will go to their own banks to withdraw the money. I don't want to keep my money in the bank accounts anymore because I'm worried that the bank's gonna fail to meet its obligations in one point in time, right? In this situation, when many people start to withdraw their deposit from the bank account, the consequence is the bank will face lacking in cash. Okay, lacking in cash. And what happens next is the bank will not be able to make loans. Loans will decrease. Many people who want to make business to grow, want to loan from the bank, want to buy a car, want to buy a house, they go to the banks and the bank tells them, sorry, we don't have enough money to lend at the moment. Okay? And this situation will cause aggregate demands to fall. Do you remember aggregate demand? Y equals to C plus I plus G plus NX. Okay? When aggregate demand falls, that means consumption falls, investment falls, government expenditure falls, net export also falls. The consequence is unemployment increases. many people will become unemployed, right? This is a situation when economic slump happens. Economic slump, economic performance going downhill, right? Inflation increases, many people become unemployed. This one we're gonna skip, which is several regulations that can be applied in order to cope with banking value, right? You can read this one, but I'm gonna skip here. Efficiency of foreign exchange market. Why efficiency is important for international capital market? Because the efficiency of foreign exchange market can provide accurate signals or information to the investors to make decisions, whether to make the investments or to delay the investments to sometimes in the future or not to invest at all. In this situation, if the foreign exchange market cannot provide a reliable signal or information, or we can call it wrong signal, this can cause misallocations of resources, right? Allocations of resources is the number one considerations in economic understanding. When foreign exchange market fails to provide reliable information to the investor, then the investor will begin to misallocate resources, right? Where the signals are reliable or not can be determined based on the following analytical methods. This is interest rate parity condition, something we have done before. Okay. Another method is using risk premium, which is an expansion from the interest rate parity condition. And the last one is exchange rate volatility. But these three methods basically are interrelated one another. I will explain to you shortly. But this one shows an example of here. Okay, this happens a couple of years ago when something happens here because of a wrong market signal, and this generates a problem for financial panic in the European Union, right? You can get the article here by typing this title here, maybe on Google, and hopefully you can still find the articles there, right? Now, first of all, let's talk about interest rate parity. Interest rate parity is something we learned before. If you still remember this equation, okay, RT equals to RT star is T, is minus across here. Yes, okay, plus. Right. Now this is an interest rate parity condition we learned before. I just arrange these equations to like this one. Now, what is important here is there are two implications, meaning that we want to see whether the capital market or the foreign exchange market provide reliable signal or not. The one thing we want to know is we want to know whether our currency will appreciate or depreciate 1 year from now, which is the expected exchange rate right here. Okay? But how do you know our currency is going to appreciate or depreciate in the future? We can understand this one by using interest rate information to perform a forecast for the exchange rate. Okay? The difference between the local interest rate and the foreign interest rate should be equal to the expected change in the exchange rate. Based on the interest rate parity condition, that means we can apply data to forecast the expected exchange rate here. We can apply data for interest rate to perform forecast for the expected expected exchange rate. Whereas the exchange rate will appreciate or depreciate in the future, right? Now this is one. This one. The forex market is good at using current information to forecast exchange rate. The current information here refers to the interest rate. The interest rate offered by the bank in Malaysia and the US, for example, and we look at the difference to make a forecast for the expected exchange rate. That's one. And then, if you look at this point, we can compare to the actual exchange rate to just the market performance in forecasting. We can use the data now. We perform forecast for the exchange rate, and then in the future we compare our forecast of this exchange rate with the real one to see whether the forecast is accurate or not. If the forecast is accurate, that means the difference between the actual and the expected, the forecast exchange rate should be very, very small, right? We can look at this one using this equation. This is the second implication. Market utilizes all information to set exchange rate. If the market utilizes all information to forecast exchange rate, there should be no error at all. This term, the forecast error, we use U to denote error. You know error? When we forecast the exchange rate and we can't 100% accurately forecast the exchange rate, we commit some error. There must be some error, right? Otherwise, what we forecast will be exactly what happens. Now, if you look at this term is actual, and this term is forecast. If the actual equals to forecast, what will be the value for these terms, for the errors? The error will become 0, correct? If your forecast is not accurate, that means the right side here it can be positive or negative value. It doesn't matter whether the difference here is positive or negative value, as long as it is not equal to 0. Then your mean here, your error here is not 0. It can be positive or negative, right? When this is not 0, that means your forecast has some problem. And the big problem happens that when your forecast in this period, T, okay, and your forecast in the future period, T plus 1, if they are correlated, that means there is systematic correlation between your errors. You commit error here, okay? For example, UT here can be 2021. T plus 1, what year is this? 22, correct? Plus 1 year. Now, you commit error here. And at the same time, you now commit errors in this year. And if the error between these 2 years are correlated, that means your error in this year is brought forward to this year. You haven't considered the error in this period. You repeat the same error and brought forward to this year. That's why they're correlated, right? So when you see the correlation between this year's error and next year's error, there is some systematic errors that you don't know, and you need to consider. You need to find out what are the errors here. Until you find out the errors, you consider the errors, you incorporate it in the forecast in the future, then you won't see any more correlation. Okay? The next thing, risk premium. Now these equations are the same like I showed you before, okay, like this one. Same equations like equation 1 here. But the difference here is that we have one additional term, which is rho. We have these additional terms, rho. Okay, this row. What is this row? This row is called risk premium. The risk premium here, just now I said, if your forecast is not accurate, there will be some error, correct? Okay? This error is something uncertain. When we know that there is an error in the forecast, not all information has been used to perform the forecast. Therefore, to compensate this risk, okay, we need some risk premium, additional payment. This risk premium will compensate this error because this error is risk. Okay, I don't want to talk more about this one, but the general message here is that because of the error, we need the risk premium. And lastly, excessive volatility. Volatility is like fluctuation. If you look at the graph here, it's going up like this and then going down, and something like that. Okay. When this happens, this is called volatility. We can't make an accurate decision whether the stock price will increase or decrease in the future. It's hard to forecast. Then if hard to forecast, how do you make a decision whether to invest in, to sell this stock or to buy the stock? Right? If you want to sell the stock, you actually borrow money from the capital market. You sell the stock, okay, and hope the stock price will decrease in order to earn profit. But if you buy the stock, here and you expect the price to go up, but the price go down, it is loss, right? When volatility is too big, then it's become harder and harder to make a decision whether you want to buy or sell this share, for example. The technique in econometrics that we used to apply to forecast volatility is called generalized autoregressive conditional heteroelasticity, or simply called gauge here. There are variants of this method called T-gauge or S-gauge or something. Okay, but this is general methods that we can use to forecast volatility. Right, let's do some revision. Unfortunately, maybe I shouldn't say unfortunately, because we are so happy to have another topic after this, right? Okay. What are the three types of gains from trade? Okay. Goods and services, intangible, and assets, right? What are the three policies underlying the growth of international capital market? You remember the three lemmas. And the policy here, fixed exchange rate, monetary policy, freedom of capital movement. Right. Okay. Number three, what are the three tests to judge the efficiency of foreign exchange market in providing market signals? We have just discussed. The first one is interest parity condition. The second one is risk premium, and the third one forecasting the volatility, correct? Okay. The bank fails to satisfy its obligations is known as the banking value, right? A country focuses on future goods and services and current domestic investment. Which type of gains from trade does this refer? Intertangible, right? It's intertangible. Right. This is the end of topic 13. Well, I have 26 slides for topic 13, and I also have 26 slides for topic 14. But like before, I'll try to skip some slides. Now our focus in this topic is about crisis, economic crisis or financial crisis. Okay. We also focus on developing countries. The reason is there are differences between developing countries and advanced economies. What are the differences? In general, developing countries usually characterized by weaker institutional quality. What does it mean by institutional quality? I don't refer to institutional quality like the quality of buildings or something, so like school or university or banks. No. Institutional quality here refers to the quality in terms of management, the qualities of administration of the countries. For example, you can consider the Ministry of Finance. The quality, if the Ministry of Finance in the countries perform very well, we call it institutional. The institutional quality is very good. Okay. So right here, let's look at this picture here. Maybe, what do you see? This last topic, I want to test your art, your painting art, the skill in painting. Well, what I see here is, if you look at the background, look at the building in the background, which countries do you think this place belongs to? Maybe you can just mention which region. Europe, okay, Europe. And what do you see among the people? What I see here is for example, if you look at this person, this one and this one, they are like fighting with each other, arguing. And look at this person. What happens to him? He's like crying. And look at these bundles of people here. They're like throwing papers away. What reasons you want to throw your papers? If you got very bad marks for your exam or something, you want to throw it away, like that. If your money or your certificate of your share or bond has no money anymore, what are you gonna do? Still want to keep it? It's just want to throw it away, right? Now this image actually tells us that these people were actually disappointed in their investment. The investment lost a lot of money, so they just like threw away everything, right? And this kind of people, they are waiting outside of a financial institution. In other words, the stock exchange. What happened is, this is called Black Friday. Black Friday happens in Europe, in Vienna. Where is Vienna? Venice is Italy. Vienna is Austria. Okay. This event is called the Black Friday, which is the Vienna Stock Exchange crash in 1873. Right? 1873. Which century is this? 1918 or 20? 19? Right. 18. 19th century. What is 19th century? Let's define here. The 19th century, from what years to what year? From which date to which date? The 1st January, 801. Oh, sorry. Okay, this 01 until 31st December 1900. 1900. This is the century, the 19th century. Okay. Now some of you might perceive that 18th century is for this one. No? It's 19th century. Okay. Right. Next thing to show here is the Fourth National Bank faced bank run. Now, this is the new words for you. Just now we learned banking value, right? The bank fails to meet its obligation, we call it banking value. Now we have the new word here, bank run. Bank run here. What does it mean, bank run? The concept here is very similar in definitions with banking value. You will see like that, about this one. Right. This is just to let you know that countries can be classified according to several criteria, several dimensions. For example, if you look at information shown by the world economic situation prospect here, countries can be classified first of all by status, like developed status, transition status, or developing status. And then we can sub-classify these developed, transitions, and developing countries by other dimensions, like whether the country is fuel exporting, by country's income, by the degree of development, and whether the countries are heavily indebted or poor, whether it is small island countries or not, whether it is landlocked developing countries or not, something like that. And from this sub-classification, we can further classify the country, for example, according to the World Bank, by different levels of income level here. Okay. You can also classify by geographical regions. For example, we have Asia, we have America, North America, South America, we have Europe, we have Asia, we have Oceania, for example. Yeah. Let's do some exercise, maybe. Identify the following countries in terms of income groups and by status. World Bank income group. We have 4: upper income, lower income, upper middle income, lower middle income, low income, and high income. 4 groups, right? Malaysia belongs to upper middle, and the status is developing. What about Singapore? This is high income, okay? And status? Developing. It's still developing countries, although very high income. Because there are some criteria to determine whether the country should belong to developed or developing, although income is very high. Spain, high. And this is developed countries. And Germany, I want Germany, high income, okay? And status is still developed, okay? Brazil, upper, okay? Upper middle.
Developing.
And this one is developing, right? Okay, Fiji. Middle? Middles, lower middles or upper middle? Lower middle. Now, okay, let's consider geography first. Where's Fiji? Where's Fiji?
Antarctica.
Okay, if you know I believe everyone knows where is Australia, right? Australia is Malaysia, Australia, and Australia's next to it, we have Papua New Guinea, and then we have other islands, a lot of islands there, Solomon Islands, Vanuatu Islands. Fiji is one of the islands there. Okay? Fiji is upper middle. Okay? Upper middle. And this is developing countries. Right? Okay, now, first thing first, now please don't laugh when you look at this one, okay? yeah. If you want to consider whether a country has converged or diverged away from a benchmark country, then this is the formulas that you can apply. This formula is also recognized in some textbook, right? Okay. Now, first of all, let us define convergence. What does it mean by convergence? In order to understand convergence, we need to have a benchmark, a reference country. For example, if you want to consider Malaysia's income convergence, we need to find a benchmark. Which country serves as a benchmark? Let's say the United States. If you want to use US as a benchmark, you're trying to look at whether this country's income converge to the United States or diverge away from the United States. Okay? This formula here can be applied to look at whether income convergence happens or income divergence. Let's look first of all look at here we have Y1. Y1 here is home currency, home income. Okay, and we have Y2. Y2 here is foreign. Maybe we should call it a benchmark. Okay, this is benchmark. A benchmark country, and we divide it by the home country's income. T minus P. T minus P can be any period. For example, now T is equals to 2022, for example, yeah? And P is equals to 10. So T minus P is equals to 2012. Okay, 2012. That means you are considering the years 2012. Okay? If P is equals to 0, that will be 2022. Right? Now you are considering 2 years. One is 2012, the other one is 2022. You want to see where does the income differences between home and the benchmark country become larger or smaller for this time period. Right? For example here, I show you a table. Now this table is actually the income per capital in 1960, and this is the income per capital for 2017. The data obtained from World Bank. Now what I'm going to do is I apply this formula using this data, and these are what I get. US serves as a benchmark country. Okay, this is the benchmark. Okay, the benchmark here. 1960, the income difference between Malaysia and between each of these countries and the US is shown here. This is an income difference, 80.6%, for example. Okay, this happens in 1960. 1960. And in this next column, we shows that the income difference, for example, Singapore, now become negative 3.52. What does it mean? From 80 to negative 3.5. That means the income difference decreases to this value. But the value is also negative. What does it mean? Singapore's income per capita become higher than the benchmark country. Okay? We can look at this by plotting these information onto a graph. This is what we see. Which country shows the very big convergence? Singapore show a very big convergence, right? Any country show divergence? Divergence should be the orange one higher than the blue one, right? So no country shows divergence. Japan also shows a very good performance. What about Malaysia? It's not bad. Okay, not bad. Indonesia is weakest. Just a very small convergence over that period of time. China's show improvement because of the technology they invest in. Now the gap between the rich and poor is called income gap. Okay? The factors that support convergence, there are two aspects: free flow of capital and knowledge transfers. Free flow of capitals here can help a country converge to a benchmark country because the free flow of capital allows the import of expertise, the import of technology, and also money capital for the home countries to develop. Right? If you have a policy that will block free flow of capital, that will block foreign direct investment, that will block expertise, that will block technologies to enter the countries. Right? Knowledge transfers. Why this is important? Because we need expertise. Expertise like through foreign direct investment, we encourage the inflow of expertise investor. And this inflow of expertise will allow the knowledge from other countries to be transferred to the local. And the local will become competitive. Okay? Competition is necessary for the countries to grow. But factors that block the convergence include anything that you can name in that will block free flow of capital and knowledge transfers will cause the countries from convergence to a benchmark. Okay? That will, any factors that block these two aspects will cause the countries to become poorer and poorer. You can see in the countries that a lot of buildings being developed, a lot of highway being developed, a lot of buildings being developed, but the people are not happy. Why? This happens, okay? Because there are factors that blocking free flow of capital. There are factors blocking knowledge transfers. People do not have the freedoms to learn, to compete. Now, features of developing countries in history. If you want to define developing countries, other than the classifications by the World Bank, by the WESP, there are several characteristics that you can understand developing countries. I don't say that developing countries will always have this several characteristics covered here, but at least one or two characteristics will be typical of developing countries. Okay? The first one is direct government control. Direct government control, this involves government intervention in many aspects. Right? Usually, especially the poor, the developing countries, like those in Africa, usually they prefer to talk about powers. Who is in powers? Because if the government has no power, it cannot control the people. For the developing country, the first step is for the governments to gain as much powers as possible in order to keep the populations under control. That is the first step. They believe, right? And have you noticed that as the country evolved from developing to developed countries, like what you see in most of the European countries now, powers are not that emphasized. What they emphasize is equality. Okay, equality. That's one example. Okay, they like to talk about power, authority. in order to manage the country and many different aspects by the government. And the other one is high inflation. I don't need to define inflation, you understand what inflation is. Hyperinflation usually happens in developing countries. Not usually, sorry. Can occasionally happens in developing countries, but inflation is common. Okay? Why? Because in developing countries, usually there are many people. When people are many, demand increases. There is a huge demand, but local production is low. They can't meet the demand. Demand high, supply low. That will cause the price to increase. Okay? There's one reason why developing countries usually characterized by high inflation. Next one. Weak financial institution or financial development. Now this one usually happens, for example, if you ever heard about fraud, for example, okay, because of weak institutional quality and because of weak legal framework. So these two aspects usually cause incompetence, ineffectiveness, inexperienced management, and so on. The other characteristic is peg exchange rate. Peg exchange rate, in other words, fixing the country's exchange rate with other countries. Why? Why do the country choose to fix the exchange rate? What's the reason? In order to reduce uncertainty, right? They want to reduce uncertainty, then they fix the exchange rate with US dollar, for example. But we already understand what is the problem when a country fixes the exchange rate. Do you still remember the dilemma? The country can only use fiscal expansions or fiscal contractions to correct the problem. Zone 1, 2, 3, 4. Go to the left or right only. You cannot go up and down when you fix the exchange rate like this. Okay? Private sectors oriented. Developing country usually characterized by private sectors oriented, like agriculture. Okay, but there is a problem when a country relies too much on the private sectors. What happens here? Let's say if natural disaster happen, floods. Okay, you know what happened recently in California? In US, California, flood happens for days. Now, what happens when private sectors is the major sector, and let's say natural disaster happens, flood, okay, destroys the plants, destroys the crops. These countries will lose a lot of money because it cannot rely on manufacturing, it cannot rely on service sectors, because they are primarily sectors oriented, right? This is one characteristic of developing country, and this is also one reason the country want to move away from developing to developed status, right? Big institution. Just now I defined institutional quality. It means the efficiency and effectiveness in management and administration of a country. Yeah. One example is corrupting practices. Corruption. Corruption is usually the factors, the number one factors that will destroy institutional quality. Right here. Now, altogether, I also want to use this graph to explain to you about your mini project. Right? You brought graph for your mini project, correct? I'm going to show you indirectly using this graph what is the problem you cause, right? Now, first of all, let us talk about your mini project. Why you can't get full mark for some of the graph? Number one, you have double title. This is a title, correct? Okay. Sometimes you put a title inside the graph and you put another title outside the graph. That is double titles. That is not effective. Okay. That's one. Second, when your title is exactly the same like your axis here. You see the axis here is index, the label here is index. I put index here. Some of you put here index, the title here, exactly the same like the title above. That's not good, that's not acceptable, right? Another thing. Source. Have you put the source of data? If you just write here source, I believe that you take the graph directly from that source. That is the explanation. Source of data, you use the data from this source to plot the graph. Right? Some of you think you would put any source here. Right. Another thing is maybe your creativity. Your creativity is to plot the graph. Some of you just, it's still the default color from Excel. I don't see any impressive creativity that way. Just now this is how I show you in a graph. If you want to make a graph impressive, you can really make the graph informative and attractive to look at. For example, in this graph, when the people look at this graph, they want to learn how to read this graph. Okay, they want to learn how to read this graph. That becomes attractive. For example, this graph, the bar here, okay, the bar here, I read from this side. And I also provide additional information, which is the difference here. Okay, represented by this box here, and this is the percentage change measured on this side. Right? And what is this used for, this yellow line? The yellow lines will see where this balance, downward or upward right here. It will see the differences, the comparison. Right? Comparison. Although I have 5 countries here, I try to make it simple, so simple for you to just 2 countries. Okay? Right, but your graph, I try to find one graph that will make me feel like, oh, this is impressive. Right? I try to say something like that, but keep looking. I just can't find. But I appreciate your efforts. Don't worry about that. I still appreciate your efforts a lot. Right. I don't want to explain this graph. You can read yourself, right? Now, developing countries in debt. External financial inflow is important for developing countries to fund domestic investment. We are talking about current account deficit here. Is actually equals to national saving is less than domestic investment, believe it or not. This means current account deficit is equals to national saving less than investment. Is that true? Maybe I will skip this line, skip this point, and this point. I will jump here because I want to talk about the equation here. This equation 2, is saying current account deficit, which is negative here, is equals to saving minus investment. This also means saving is less than investment. Why is this the equation? Now, okay. Y equals to C plus I plus G plus net export. Okay? I rearrange this one. Y minus C minus I minus G. Okay? I minus G. And then this equals to NX. Now, Y minus C, income minus consumption, income minus investment, income minus government expenditure. What does it equal up that? The extra amount of money is equals to the extra amount of money that you don't use for consumption, you don't use for investment, you don't use for expenditure. This is equal. Saving. Right? Saving. So this one will become saving. Okay, right here. Saving equals to net export here. Okay? But if I take out I from this equation, this will be equals to saving minus I equals to net export. Net export is equals to export minus import. Okay? If export is less than import, that will become deficit, current account deficit, which is equals to saving minus investment. Right? Let's skip this one, just to explain to you this question. For the rest here, you can read this myself. The more important things here is the crisis. Okay, this is something I want to focus in this topic, which is financial default. Crisis. Financial default here means when the country borrow money from other countries, but was unable to repay this money borrowed in the future. That is called financial default. But this financial default can lead to other crises like balance of payment crisis and bank value or bank run crisis. Okay? Balance of payment crisis here happens when the countries need to use foreign reserve to pay off loan. For example, if a country borrow money from other countries, at one point in time, the country will have to repay the loan. But if the country repay the loan using foreign reserve, the volume of foreign reserve in that country will become lower and lower. And eventually, this country will not be able to maintain the fixed exchange rate, because to maintain the fixed exchange rate, the country must keep foreign reserve or foreign money or foreign currencies. Okay? When this foreign currency becomes smaller and smaller, this country will not be able to maintain this exchange rate. Now what happens? When a country cannot maintain this fixed exchange rate, what happens is the only choice for this country is to remove this fixed exchange rate regime. Now what happens? When you remove this fixed exchange rate regime, the exchange rate will become floating. It becomes fluctuate again. You try to imagine one problem. You have been keeping this exchange rate fixed for a long time, and suddenly you remove this fixed exchange rate. What will happen is the exchange rate will like rocket up or down. Okay? I don't know how to explain with example for this one. It's just like some things want to go up, you're holding it, and suddenly you remove it. It just shoot up and down, right? Okay, it's bouncing up and down. What happens is when you remove the exchange rate fluctuate up and down. The worst situation is when the exchange rate, the currency devalue, depreciate a lot. This will follow. When people realize that your currency value drop a lot, that will create panic by local and foreign depositors, because they believe that when currency value drop, I can't use my money for with variable expenditures. Depositors will try to withdraw the money from the bank and try to shift their monies to other areas. Okay? This one is actually the reasons underlying the 1999 financial crisis, right? I will explain to you about this one based on the diagram later to explain the financial crisis. How this one lead to a major economic recessions in South Asia in 1997. before. Okay, I don't want to confuse. I don't want to disturb you, interrupt your follows of these lectures with this diagram here, this table here. This is something you can read by yourself later. Okay, I will jump straight to explain the Asian financial crisis here. Okay, what is the starting point of Asian financial crisis? Speculation attack. Speculation attack in Thailand. This is the starting point of the financial crisis, meaning that during this time, a lot of people knew that currency value in Thailand drops. What is the currency in Thailand? Baht, right? The Thai baht dropped in values a lot during this time. Now, you notice that there are a lot of investors in Thailand, foreign investors in Thailand. They put their money in Thailand. Hopefully, they can build businesses to make money, to make earnings. What they realized during this period was that the currency value in Thailand drops a lot. So they will try to think, what should I do during this period? They will feel like not confident with their money, right? The peg exchange rate regime in Thailand was abandoned. Now, what followed is when people believe that the currency value in Thailand drops, right? They will try to believe that they should not keep their money in Thailand. That is one aspect. Another major aspect that we need to understand is when the currency value in Thailand drops, Thailanders will not be able to maintain the peg exchange rate regime. As I said, in order to maintain the peg exchange rate regime, you need to keep federal reserve. That means foreign reserve, foreign currencies. Otherwise, you can't keep this fixed exchange rate. But when the value of Thai baht increases a lot, that means Thailand need to keep even more foreign currency in order to peg this exchange rate with US dollars. Unfortunately, Thailand was not able to continuously demand foreign currency again and again to keep this fixed exchange rate because the burden is very high. You cannot just keep borrowing money, and keep borrowing money to keep this fixed exchange rate, right? Eventually, what happens is the Thai government removed this fixed exchange rate regime. They remove it because they can't afford to borrow even more money to keep this exchange rate. So eventually, they open up this peg exchange rate. And the consequence I already explained to you. When you remove this peg exchange rate, the exchange rate becomes floating, right? Just like you're holding for a long time, and suddenly you remove it, right? Or you're going down, remove it. It just dropped a lot. Currency value in Thailand dropped even more after removing the fixed exchange rate. Will that generate even more panics to the people? The depositors feel even more unconfident with the Thai baht because the value dropped even more. Okay? The consequence is the floating exchange rate raised investors' panic. Now this is very spicy, yeah. Okay, since we are talking about Thailand, okay, we love to talk about sours, spicy, hot, something like that. Right, the floating exchange rate raised investor panic. What happens is capital flight. Capital flight here means investor try to withdraw their money away from Thailand and go to other countries. That is capital flight. Okay? When capital flight happens, that means a lot of money will flow out of Thailand. Thailand will not have enough money for domestic uses, right? Okay? This is sour. It's very sour, right? Okay, now currency devaluation, Thai baht was worsened. as I said just now, the currency value of Thai decreases a lot, right? So this is called currency devaluation. The problem is the private debt increases tremendously. Meaning that when the currency value decreases a lot, your debt, I mean Thailand's debt will become higher. Okay? Because when the currency value drops, the debt that you're gonna pay will become higher and higher. Right? Because the currency value becomes weaker against foreign currencies. This is hot. Eventually, it becomes what? As you can see here, this has become Ham Yong Gung crisis. You know this noodle, right? You know this noodle? Yeah, this is not what I say. It's available if you look at internet. Yes, there's a word like this. Ham Yong Gung crisis. Yes. Okay. The subsequent problem is stock market and other asset devaluation. This is because of when the debt increases and the currency value becomes low, right? And this transfers to the decreased value in stock and other asset market. And overall, similar currency devaluation occur in most Southeast and East Asian countries. What happens in Thailand is spillovers to other Asian countries like Malaysia, Vietnam, Korea. Okay, spillovers to other Asian countries because the general panic, general speculation. What happens in Thailand will happen in other neighboring countries because usually Thailand will have a strong trade connections with other neighboring countries. So people believe that what happens in Thailand will also happen in other Asian countries like Malaysia, Philippines, Indonesia, for example. Yeah. So panic also happens in other Asian countries, and eventually other Asian countries also experience economic recession, like Malaysia. Okay. Okay, but anyways, the Asian financial crisis actually produced some essential lessons. The lessons will help countries nowadays to adopt measures to avoid possible financial crisis. Yeah, there are several lessons here. I just mentioned, roughly mentioned. You can read the point here yourself later. One is appropriate exchange rate regime. Fixed exchange rate regimes not necessarily produce the desired result. Sometimes floating is important. Yeah? Banking. Banking, as I said, is the intermediaries. It's the central of people's transaction. So banking must be properly regulated. That means regulations must be upgraded, must be revised. Measures of economic reform. Economic reform should come from internal to external. Meaning, if you can strengthen internal economic management, then you can go upward. It's not like before you learn how to run, you want to learn how to fly, there's going to be a problem, right? So just like economic reform, you have to strengthen internal problem to solve internal problem, strengthen internal structure before you go upward to international level. That is the process, right? So financial development is very important here. That means the country must strengthen, must improve financial development. Contagions. Financial crisis works like contagions, just like the pandemic. It can spill over from one country to another very quickly. This is generally because of the general panic, general loss of confidence. This perception can be transferred from one country to another country. Yeah? Because people can mobilize from one place to another. And plus, nowadays we have the technologies that can spread news, other rumors and other things very quickly through internet, right? Policy tyrannies. Again, you want to handle financial crisis, you also need to deal with the policy trilemmas. Just now we have mentioned treaty policy. This is a diagram that give you a different look. One is monetary policies. Okay? The opposite of monetary policy is monetary bond. Exchange rate stability. This is also fixed exchange rate. Okay? And the opposite of fixed exchange rate is floating exchange rate. And lastly, freedom of capital movement. And the opposite of freedom of capital movement is you control the capital movement. And as I said just now, the country can only pick one of the two of the three policy. You cannot use three together, right? So to deal with financial crisis, it depends on whether the country will prefer this one, or maybe this one or that one, or this one or this one. It depends on the situations of the countries, right? Okay, risk reduction. I don't want to talk about this one, which is also the last slide. Okay, last slide. I don't want to talk about this. We can read about this yourself later. Just some measures to reduce risk of financial crisis here. Okay. Some quick revision. The two possible factors that brought economic convergence include free flow capital movement and knowledge transfer. Right. Foreign exchange reserves are used to pay off loans. Lowering this reserve means instability to maintain exchange rate. What do you call this crisis? TOP crisis. Okay. Does FDI belongs to equities or debt? Finance. Equities. Right? Does bond belongs to equities or debt? Finance. Debt. 5. What are the three aspects involved in the policy trilemmas of international economics? Okay, exchange rate, capital control, and one more, currency board. Okay. Right, that's all. Go topic 14. Do you want to take a rest 5 minutes before it begins the quiz or something else? Just a very easy question. Just very easy question. I believe we can answer this in 5 minutes. Right. Like I said before, I will give you 30 minutes to answer this quiz, but you can finish early. You can just submit and you can go, right? You can find your groups. You can, as I said, this not the first notes. You can find your groups, sit together. I will give you this question.